Hello everyone, welcome to another live. It's tax time, so I wanted to jump on live quickly this week to go through the start of tax time. My main topic I'm going to talk about early on here is going to be about, when's the best time to lodge your tax return. So if you're watching it live or you're watching on the replay, it's kind of a question that I'm getting asked a lot. So I want to go through some of the lessons I'm learning from some of the early returns I've lodged so far, or some of the people who have contacted me to get their return lodged, some of the potential issues we're running into with information, kind of where things are at. And obviously, like talking about the implications of what happens if you lodge early and things are wrong, etc. I'll obviously jump in. If you haven't been on a live before, I do jump in and answer a few questions that were asked through the week over on Instagram. And then if anyone's got questions, comments, tax time, any kind of queries, etc., drop them in the comments and I will get to them as well. See, Chris is here. G'day, Chris. Hope you're going well. Chris has got his own live in about an hour's time, so hopefully some people will head over and check that out. So, it is tax time. So, like I said, I'm starting to start the process of getting tax returns done. I've already lodged a handful of them already. A lot are in progress. We're waiting on bits and pieces, which is the main stuff I'm going to be talking about tonight. But, you can definitely go and lodge your return now. I don't know what the stats are, but a couple of years ago, there was a lot of people that lodged on 1st of July, like hundreds of thousands. So I think they actually had a record year a couple of years ago of the amount that lodged on 1st of July. So it'll be interesting to see how that stacks up this year. So the main thing you're looking at to be able to lodge your return if you've got employment income is it tax ready? So it has to have that tax ready status, your employment income. So you can check this on MyGov. I believe if you try and do your own return through the ATO system, it will tell you whether it's tax ready. And me as an agent, so when I go on, it will give me a flag to say whether it's finalized or not. And what it is that this replaces the old group certificate or the payment summary system, is the single touch payroll system. So you get income statements now, I believe they're referred to, and they get filed each pay run. So you'll be able to see your income earned year to date. And then at the end of the year, your employer has to make that tax ready. So that's when they've gone and reconciled all those figures and made that tax ready. So you really shouldn't lodge until that happens. And the reason for that is they may be still reconciling things on their end. Maybe they've, I've worked with a few clients and they've actually made a few mistakes on what they've actually physically transferred employees. So they've got to have to look at how that feeds into the data, etc. Those are the kind of things that could happen. So you want to make sure you got that, especially if you've got any kind of salary sacrifice, fringe benefits. You want to make sure that you wait till this is done, because they have to manually feed that into the finalization in most situations. So that will be my recommendations here. Wait till you see that tax ready status. So if it says not tax ready, they made it pretty simple this year. It's just not tax ready or tax ready. If it's not tax ready, then you shouldn't be lodging. That's the basics of it. That's just talking about your employment income. So we're just talking about employment income is what this tax ready is. Sarah Dactor's joined us. G'day, how are you? Mum's here. Hello. So that's what you're looking for is it tax ready? And that's talking about employment income. And then obviously there's a range of other things that you may be waiting on. So for instance, if I run through some common things, if you got questions about any of this kind of stuff or what I'm seeing so far, but look, I'd say it's probably maybe a third to a half of employment income is tax ready. Private health, I'm starting to see some funds flow through. So I know Bupa has made their information ready. Interest, I've only seen, off the top of my head, I only remember seeing ING Bank so far across the clients I've worked with. I haven't seen many other banks finalize their interest figures. Like I said, employment, there's some dividends that are coming through. So my own personal, I've got some dividends and they have come through. If you've got like ETFs, they're likely to not be ready yet. So there's some of the things you're looking at. What else? If you've got capital gains information, a lot of the time you should be producing that one yourself. Obviously, crypto is the same. If you do have crypto, you will see those warnings popping up. So let's see some of the questions that are coming through. The disgruntled octopus is catching the replay because he's awaiting the donut delivery. What happens if working for a small business and it not shows tax ready? So the ones that aren't tax ready, they have until the 14th of July before they have to make it tax ready. So they've still got, today the 6th, so they've still got over a week. So until then, there's nothing you can do. If it's not tax ready by the 14th, then I would speak to your employer as a starting point. That's always the best way to do is have a chat to your payroll division, find out what's going on. When are they going to finalize it? Is something gone wrong? I've got a few clients where their employer has switched payroll systems through the years. They've got two separate amounts coming across, and it's a bit messy. Sometimes if they've really stuffed up, one amount shouldn't be included, etc. So you've got to be a bit careful on that. But if you're still getting nowhere and they're not doing it, then you can speak to the ATO. I don't know how much luck you have with them following it up in the short term. You can always lodge if you know that those figures are pretty accurate. You could lodge if it goes past the 14th of July, but you do run the risk. So Captain Op Shop Nerd is here. Howdy. G'day. I hope you're going well. Random question from Chris. As an accountant, do you get many questions, requests about how to manage interest rate hikes? Looks like it's going uphill to Christmas. Yeah, I mean, I'm not obviously I'm not a mortgage broker, so I'm not getting those. But yeah, the reality is I've put a few things out on Twitter and Instagram recently about interest rate hikes, and over on YouTube, you got to budget for these things. Like when you take on any kind of finance, you want to make sure that you've got some buffer room in it, because if you don't, you're definitely going to struggle when it comes to any kind of interest rate hikes. And so when the bank normally does an assessment of your serviceability of a loan, they normally will buffer in some room, so it might be 3 or 4% higher than current rates. But you should be doing that in your own budgets when you're working out any kind of financing. So yeah, there's not a lot you can do. I mean, you can obviously look at fixed versus variable rates, etc. But if you're on a variable rate, or even if you're on a fixed rate that's shortish term is going to end soon, you want to see what it looks like if those rates go up. How are you going to afford that? Where are you going to pull the extra funds from? Obviously, that becomes more and more important the more finance you're taking on. Therefore, an interest rate rise is going to have a further impact on yourself. So, what makes you think they'll stop in December? Who knows at the moment? It's definitely an interesting economic environment. So, I'll talk about some of the risks of lodging early. So, the problem is if you lodge early, you do run the risk that it's wrong. And that means either you've got to do an amendment or the ATO's got to do an amendment. So, if they find you haven't included income, you're likely going to get a letter that says you got to do that. And obviously, if it's most of the time that amendment happens, it's people leaving income out, not leaving deductions out. So it results in them owing money back because they would have either got a refund, so they got $2,000, but they should have only got $1,500, and therefore you're going to end up with a debt of $500. And you probably would rather just get the $1,500 in the first place, or maybe you owe $2,000, you're going to pay it now, you've got to go and find another $500, for instance. So that's the risk of lodging early. And the ATO will start to get this information fed in. And if you haven't included the stuff that they're, prompting you to say should automatically be in there, you're definitely going to, red flags are going to go off everywhere, and you likely get an automatic letter. Like it's not even going to be a manual process. So that's one of the major risks of lodging early. And, it's that stress of, is it actually right what you're lodging? That's always the risk. And, the ponderous pufferfish, is there possible we can overthrow the RBA? Good luck. It could happen. Unlikely, but so that's the main risk of lodging early is, you're going to lodge, but you've just got that risk that it's not right. And if the ATO deem that you've obviously deliberately lodged early when you've known there's information, you do run the risk of potential fines or interest penalties for, tax deceit and things like that. So you definitely want to be careful what you're lodging and get it. At the end of the day, the ATO aren't going to start processing returns until likely mid-July anyway. So they don't necessarily, just because you've lodged on 1st of July, doesn't mean yours gets dealt with first. So there's not necessarily a huge rush in that first week of July or even the first 2 weeks of July. I'm really surprised the ATO almost don't say, well, everyone's got to have all the information in by the 14th and you can start lodging from the 15th. Like it could, I'm surprised they don't even go down that path, to be honest. So I don't think, obviously if you've got all the information, I've done returns for people so far that we know we've got everything and there was no issue with us lodging early. But if you're not sure, you're better off to wait. And like I said, there's a lot of back and forth at the moment I have with clients because things aren't ready. So we're putting a lot of things on hold. So, if you're stressing, and then I've got other people thinking they have to have it done by 1st of July, and you've got heaps of time. Even if you're lodging yourself, you've got until the end of October. If you're going through an agent, you've likely got to the middle of May next year anyway. So you've got heaps of time before you need to lodge. And just a few, like I said, a few other things on tax time. You're not going to likely see refunds till middle of July anyway, maybe slightly earlier. I haven't heard of any clients getting them back yet. The ATO will accept the return, but they just won't process that yet. Like I said, you've got heaps of time still to lodge. Comments, yeah, if they're not done in lodgement order, I don't even know how they pick which order they go in. Look, in general, they should be done in that order, but it just doesn't always work like that. I've seen 2 returns lodged on the same day that don't always come back at the same time. So that's just, it doesn't seem to work like that. I mean, in general, yes, they would be processing older ones quicker than newer ones, but there might be certain things that flag why yours doesn't get done at the same time, etc. So don't stress if you lodged on 1st of July and someone that lodged on the 3rd gets their refund before you. It's not always like that. We got one. How does the audit process work, and is it common to be audited? So, look, it's not very common to do an actual audit beyond, obviously, these kind of things where it's discrepancy. It's like, say you had $200 of bank interest that you didn't include, or you stuffed up something on your Medicare levy, etc. Those things happen all the time, and I call them like automation audits, and they happen all the time. But as far as like an actual audit for not include, like as far as like deliberately, they just want to do a random audit on your work-related expenses or stuff like that, it's not overly common. But when they do one, they are very particular. So they'll want, all those receipts. If you've claimed car expenses, they'll want a registration notice to show that that car was registered in your name. If they, if you've claimed kilometers, they're going to go, well, how did you come up with this calculation? They're likely to call your employer and say, well, did this person actually need to use their phone for work, or do you supply uniform, etc.? So the audit process is, normally they send out a letter to either yourself or your tax agent, but it can be quite in depth when they actually do it, but they don't do a lot. So, they might do 1 in 1,000, but they want to make sure they get something out of that one. That kind of seems how they process. So maybe Aaron Aardvark gets his tax return first. Yeah, maybe it's like alphabetical order and date. Who knows? How many $1 billion do we have sitting in the bank to get $200 interest? Well, less, a lot less now because the interest rate increases. Now, it'll be interesting to see whether they put the interest rates on savings accounts up as quick as they do on lending. So, would you say it's common to go your entire life without an audit? Yeah, I'd say a lot. Like in general, a lot of people will never get an audit in their life. Some people get 2. I don't know. I'm assuming probably in their system, if you get an audit and fail it, you're probably at a higher risk of future audit. But yeah, there'll be plenty of people that never get an audit in their life. So I've lost cash in stock I bought last year. I still held. Can't do anything around CGT loss yet, can I? No, not if you haven't sold it. There's nothing. Yeah, if you haven't sold, in shares or crypto or property, and it's gone down in value, but you haven't sold, it's just an unrealized loss, and nothing happens until you dispose of it. I did have another question that come in early in the week, and I'm not going to stay on too long tonight, but work from home reverts away from 80 cents. Should I be calculating time work differently now? So I would still do the same thing, keeping track of your hours, because even though the shortcut method will likely be going away, there is a fixed rate method that you can combine with other work from home expenses, and it's just at a different rate. So I've done a video talking about home office expenses and the different methods, and it's likely most people will revert back to that. So it's still a good idea to keep track of your hours that you're working, whether it's by some kind of journal or if it's a set amount per week, it's a bit easier. So even though the 80 cent shortcut method is likely going to finish, there is still a very similar method at a lower rate that requires you to keep that same thing. So do the same calculations rather than go and change method, if that makes sense. Can you give a brief explanation on how tax on a property works and also private health insurance? So I do have a couple videos early on my channel talking about properties, but pretty much if you've got an investment property, you're going to include the income and expenses of that property, and that will go into your return. If you made a profit, it adds onto your taxable income. If you made a loss, it takes off your taxable income. And so income's pretty easy. That's going to be rent or any reimbursements you've got for other expenses, such as water rates, etc. And then your expenses are going to be council rates, insurance, repairs, property agent fees, water rates, emergency services levy, land tax potentially, gardening, cleaning, etc. And then you've got interest, which is the key one that people often get a little bit confused on. So it's only the interest portion of your loan repayments, not the actual loan repayment. But that all factors in. If you're in a profit, it's called a positively geared property, and that income is going to be added to your taxable income, and you pay tax at your marginal rate. If you're at a loss, it's a negatively geared property. That loss will come off your taxable income and will save you tax at the marginal rate. The other thing you could have is depreciation. So on capital items, so anything that is a capital item, and if you have a look, they actually have some guides on this, and they get depreciated at different rates. Or you may have gone and got a depreciation report through a company like BMT or something like that, where they go through and they value everything existing in the property. It's a little bit different rules these days on existing properties versus new properties, and a capital works deduction, and all these things can factor in. They do play into capital gains. So it's a pretty complex area if you dive really deep into it. But a real basic is going to be, did you make a profit or loss off the property? And that will come on or come off of your taxable income. With private health, I want to do a full video on this talking about private health. At the end of the day, the way private health affects your tax return is if you're not claiming the rebates ongoing, then you get them through your tax return system. If you're in the right bracket, it won't make a difference. If you're out of the brackets, then you could end up with a refund or a payment on that. And then the other main areas, if you've got hospital cover, you avoid the Medicare levy surcharge. If you don't have hospital cover, then that doesn't come into play. And so it depends on how much your income is to whether having private health will actually save you on tax. I'm going to do a full video on that, but hopefully that gives a brief summary of how that works. So is it down to 56 cents for the work from home? So it's 52 cents, I believe, is the fixed rate, unless that's changed at the moment. Off the top of my head, it's 52 cents for previous years. I don't know if they will adjust that. They likely may, because it hasn't changed for a while, though. But yeah, that's that one. So that was a few questions I got. I do appreciate those that have jumped in. Of course, I will quickly touch on, I do have the NFT project. I won't talk about it for too long, but I've still got that. We've got some changes coming to that soon. So if you want to check that out, that's Rooshock's. And of course, I am doing tax returns for people. So Rucioch Accounting is the business name. Send me an email, ethan@rushocaccounting.com.au if you're interested in getting your return done, or contact me on Instagram, Twitter, through our website, anything like that. And yeah, appreciate everyone that's been checking out some of the YouTube content. The channel's been going really well the last week with tax time starting. So I appreciate all that. And for you, those of you that aren't doing anything in about 45 minutes time, Chris is going to be doing a live. So if you want to jump over and watch that, there might be a sneaky giveaway over there relating to the NFT project. So appreciate everyone tuning in, and I will talk to you again soon.